Hello guys, welcome to Bhavna's Online Academy. In this video, we are going to learn AS20, which speaks of your earnings per share. So in this video, we are going to cover all the concepts related to AS20, and also there's going to be a part 2 video which is going to cover all your ICI questions. So make sure to watch both the parts to get a complete understanding of this AS20. Apart from that, today I'm going to use my handwritten notes for you to teach AS20, and this handwritten notes will be available on my Telegram channel free of cost, and the link of which is given in the description box below. Make sure to check that out also. Yes. So now without any further ado, let's start with AS20. So starting with the introduction and objective of AS20. So what is earnings per share? What do you mean by earnings per share, and why was this AS20 brought into force? That we are going to first understand. So here first they are saying that EPS is a measure of performance of the company. How do you measure the performance of a company using an EPS? What is EPS? So when a company is run, a company is always run to earn. It is always run to make profit, to earn, and all of that, correct? Yes. So when the company is going to earn and when the company is going to make profit, it is going to distribute this earnings or distribute these profits to the owners of the company, So now who are these owners? So these owners of a company are the shareholders. The owners of the company are these shareholders. So what the shareholders would have done, the shareholders would have invested their capital at the start of the company, okay, so that the company could run and generate some income. And now once the company has generated some income out of the money which was invested by the shareholders, now this income will again go to the shareholders as a earning, as a return to its investment, So in simple form, it means that the company has some earnings or profits during the year, and these earnings or profits are distributed to the shareholders. So when it is distributed to the shareholders, there can be numerous shareholders. In the company. What does one shareholder of the company earn? Suppose the company has earned around 10 lakh rupees in a year, and there are around 1 lakh people who are shareholders in the company. So how much does each shareholder in the company earn? If this 10 lakh rupees is distributed among these 1 lakh people, then rupees 10 will be the earnings which each shareholder has got. So this 10 rupees will be called as your earnings per share. That is, out of the total earnings which the company is earning, how much does each shareholder in the company earn? Is called earnings per share, which is 10 rupees. Now, how is this useful? To calculate the performance of the company? For example, now you want to invest in two companies, okay? This is company number 1 and this is company number 2. Okay, and imagine you have seen all of the factors. Both the companies are identically the same only. Or the only difference between both the companies is the EPS. Okay, so the company 1 is going to give you an earning per share for every share that you get in the company. For that, in return, you are going to get 10 rupees. In company 2, you are going to get 100 rupees. Given you have invested the same amount of money. Okay, so now when you compare company 1 and company 2, which company would you want to go and invest into? You would want to go and invest into a company which is giving you higher earnings, given all the other factors are same. Okay, so you'll go and invest in the company 2. So this is how you are able to understand how each company is performing and how each company is earning. Plus, you are able to compare between different companies as well. Okay, I hope you understood this. Now they are telling you that EPS is of two types. There is one which is known as basic EPS, another one which is known as diluted EPS. So now what is basic EPS, what is diluted EPS is what we are going to learn in the complete AS20. So for now, you need not focus in that. Next, they are telling that what is the objective? What is the objective of AS20? Why has been AS20 brought into force? Why do you have to study AS20? You have to study AS20 because this AS20 is going to help you determine. How to find out what will be the EPS. What are the steps to find out the EPS? That it is going to help you with. Second, it is going to help you with how you have to present that EPS in the phase of P&L. once you show your profits or your earnings, before the after the profits or earnings, you will show your EPS. After the profits or earnings, you will show your EPS. So how you have to present it, in what format you have to present it in the face of P&L, that also AS20 is going to teach you. Okay. So now AS20 will teach you how to calculate it. Second, AS20 is going to teach you how to present it. Okay. And they are telling you this will improve the comparison performance along. So how is it going to help you? So once you calculate it and present it in your face of P&L, how is this EPS going to help you? First, we have already understood between different enterprises. So this we already understood, that between different enterprises for the same period, you will be able to compare, like how we compared company 1 and company 2, like that you can compare and understand the performance. Otherwise, for the same enterprise itself, like for company 1 itself, you can find year 1 how much was the EPS, year 2 how much was the EPS. So like that, if you compare, you will be able to see for different period how is the company performing. Suppose in year 1, the company 1 earned a EPS of 10 rupees. In year 2, it earned a EPS of only 8 rupees. That means the company's performance is deteriorating, correct? So like that, same enterprise also you can see how is the performance by differentiating or by comparing different periods in the same enterprise. Okay. So I hope you understood this completely. So now moving upon the definition part. So we are going to see the definitions of different types of shares. Okay. So first one is your equity shares. Okay. So what does equity share means? The definition of equity share says it is a share which is other than a preference share. So anything other than a preference share will be called what? Will be called as a equity share. So now we need to understand that what is a preference share, so that we are able to understand what are equity shares. So what is a preference share? So preference shares are shares which carry a preferential right. It means it has a priority to get dividends and repayment of capital when the topic of dividend is going to come. So when a company is going to earn and when the topic of distribution of earnings is going to come, first priority will be given to preference shareholders. After the earnings have been distributed to the preference shareholders, only then the earnings will be distributed to the equity shareholders. Same way, when the company is going to get liquidated and all the capital is going to be repaid, at that time also preference shares will be given an upper hand or a priority, and the remaining will only be distributed to the equity shareholders. So they have preference. So whichever shares does not have a preference, that will be called as a equity share. So this is the difference between equity share and preference shares. Now there is something called as a potential equity share. So now what is a potential equity share? It means currently, right now. Okay, right now it is not a equity share. It is in some other form. It is not a equity share. But in the future, it will get converted. In the future, it will get converted into an equity share. Currently, right now, it is not an equity share. It is in some other form. But in the future, it will get converted into an equity share. So, it will become equity shares in the future. Okay. So, now here I have given you some examples. First examples are convertible debentures. Convertible debentures means what they will do. For example, I'll give one example of this. That there is a company and the company is telling that currently we are going to issue you debentures on which we will pay you interest. Okay, and let this go on for 5 to 6 years or 10, 11 years, whatever the time frame is. After that period has been ended, what they will do is they are going to convert these debentures. Into equity share. They will tell you, if today you are having 10 debentures, if today you are going to get, why is this not writing? Yes. So today if you are having 10 debentures, they will tell you that in the future, example, after 10 years, I will issue you one equity share instead of this 10 debentures. One equity share instead of this 10 debentures. Okay, so it means today it is in the form of debenture, it is not equity share, but in the future, that is after 10 years, it can get converted into an equity share. That is why it is called as a potential equity share. The same way there can be convertible preference share also, that today it is a preference share, in the future it can get converted into an equity share. Then next is something is called as share warrants. There is something called as employee stock option or options also. In such case, so if the employees are going to opt for this option, then in the future for them they will get some equity share. Then there are contingently issuable shares also. So these are all the examples of potential equity shares. Okay, I hope you understood this. Okay. So next we are going to understand about basic EPS. Remember I told you in the start that EPS is of two types, basic EPS and diluted EPS. Now we are going to first understand about the basic EPS. So basic EPS, I told you, in the starting itself I told you, if the company is earning 10 lakh rupees and if this 10 lakh rupees is going to be distributed between 1 lakh shareholders, then rupees 10 is going to be your earnings per share. So this is nothing but your basic EPS. So this is nothing but this EPS of 10 rupees is called your basic EPS. Okay. So your calculation of basic EPS, you will write what is the, in the numerator you are going to write what is the profit or loss which is attributable to the ordinary equity shareholders. That means here you should not think about potential equity shareholders. Okay. Here you do not think about potential equity shareholders. Currently in the company right now, it means currently right now in the company, how many equity shareholders are there? Not potential, currently how many? In real, how many equity shareholders are there in the company? To those equity shareholders, how much earnings is attributable or how much profit or loss is attributable? Calculate that. Divided by the weighted average number of equity shareholders. Okay. So what is weighted average? That also I'll teach you. For now, you think that profit or loss divided by the number of equity shares. If you do, you will find out basic EPS. So now we are going to understand the numerator and denominator in detail. How do you calculate the profit and loss which is attributable to the equity shareholders or the ordinary equity shareholders? Why is the word ordinary important here? Because it means it is not potential, it is a normal equity share. Okay, so how do you calculate that? So you first will find out what is the profit after tax. That means profit, you will do profit before interest and tax, minus you will reduce the interest, minus you will reduce the tax. After doing all of this, what is your profit after tax? Find that out. From that profit after tax, this first you will pay some dividend to the preference shareholders also, correct? So reduce that dividend which is being paid to the preference shareholders, okay, including if there is any tax, you have to reduce that also. So whatever is remaining after that will be the profit which is attributable to the equity shareholders. It will be the profit which is attributable to the equity shareholders. Okay, so you have to do profit after tax minus the preference dividend. Okay, so this is how you find out the numerator. Now let's understand the denominator, which is weighted average number of equity shares. So number of equity shares is easy. What is weighted average? What does this mean? We are going to learn that now. So how do you have to calculate it? Weighted average number of equity shares. Okay. So now when you usually do some calculations, right? So whenever you are distributing your earning, for example, there are two shareholders in the company. For example, there are two shareholders in the company. The first shareholder in the company, suppose the company's financial year is April to March, or for easiness, let's take from Jan to December is the financial year in the company. The first shareholder joined the company on January itself, and he got one share in the company, The second shareholder joined the company on August. Suppose August 1st, he joined on January 1st, he joined on August 1st. Second shareholder joined the company of August 1st and again got one share in the company Now the company earned by December end. The company suppose earned 1,000 rupees. And what did the second shareholder tell to the company is that, okay company, if you have earned 1,000 rupees and one share is with first shareholder, one share is with the second shareholder, then you can distribute it equally between us. So that 1,000 rupees what you have earned during the year, you can distribute it equally between us. That means first shareholder can take 500 rupees, second shareholder can also take 500 rupees. Now, this first shareholder got really angry. When the company asked him why, he said that, see, I joined the company on January 1st itself. This second shareholder joined the company only on August 1st. Correct. So how can you equally distribute this between the two? This is very, very wrong. So what did the first shareholder suggest is that, and this is what was adopted also. So what did the first shareholder tell? That whatever earnings is there, that the company is going to earn, suppose, okay, The company has earned 1000 rupees. In that, I should get my 12 months share. But this second shareholder, because he has only come from August 1st, that means from August to December, how many months are there? August, September, October, November, December, 5 months. This second shareholder will only get a 5 months share. This understood? I hope you understood this. Okay. Find out weighted average number of equity shares. This calculation is what we are going to shortly call as Vayne's calculation, which is weighted average number of equity shares. So Vayne's. So how are you going to find out the denominator, or what we call this the Vayne's? Because when you're finding basic equity share, basic earnings per share, you have to put a denominator. So this denominator means it is the number of ordinary equity share which is adjusted by the time factor, for which I just gave you an example. Okay. So now let's understand how you have to calculate. So these are the steps you have to follow, and by doing this you will find out. Take number of equity shares which were outstanding at the beginning of the year. That means from the year start, how many equity shares were outstanding in the company. Write that. Example, 500 shares were outstanding in the company. Then find out the number of equity shares which was issued during the year. Like that, on 1st August, how many shares were issued during the year? Multiply it by the period weight. Because only proportionate earnings they should get. They should not get the earnings which is for the full year. Okay. Yes. So how do you do it? You have to first write number of equity shares which are issued during the year multiplied by number of days or months. This number of days or months, I put a star here. Okay, I'll tell you what number of days or months you have to take. You have to take that divided by 365 or 12. That is not 365 multiplied by 12 or 12. This is also 365 or 12. That is 365 days or 12 months. 365 days or 12 months. Okay, take that. Then you have to come to the fourth one. There you have to take number of equity shares buyback during the year. What is number of equity shares buyback during the year? It means that so a company can also issue equity shares in a year, okay, to get extra money from the shareholders, as well as the company can also buy back its equity shares. That means already it would have issued some equity shares in the past. Those shares the company can also buy back. Why do we have to find out this? Because after the shares have been bought back, whatever earnings were made, suppose example the year was from Jan to December, okay, and on 1st November, what happened? The company bought back around 100 shares from the shareholders. Now the shareholders should only receive an earning for those 100 shares between Jan to November month. What the company has earned between November to December, that 100 shares should not get those earnings, because those 100 shares were taken back from the shareholders. And whichever time this shareholder was holding this share, which is from January to November, only for that period of time, the shareholder will get its earnings. Okay, I hope you understood this. So that also you have to multiply it by the period weight, which is number of days or months divided by 365 days or 12 months. Okay. Then finally, you have to also add bonus shares. And bonus shares, whatever the company is going to issue, you should not do any time basis on it at any point of time. So it means that, what it means is that bonus shares alone, whether it is issued at the start of the year or mid of the year or end of the year, it does not matter. You should not do any time appropriation for it. How many ever bonus shares were taken, just directly write it here. Please do not do any appropriation for it. Okay. So I hope you understood this. First, what we have to take, how much shares were outstanding at the beginning, how much were issued during the year multiplied by the time factor, how much were buyback during the year multiplied by the time factor. Bonus issue alone, please don't multiply with the time factor. Okay, take all these shares. So this will be your, if you total all of this will be your Vayne's. And here always remember, these buyback shares which are there, it has to be reduced from this calculation. So beginning of the year, your shares you have to add, issued shares you have to add, bonus shares you have to add, but whatever shares have been buyback from the company, it means it has been lessened from the company, it has been minus, correct? So you have to lessen it from the total calculation, and the remaining will be your Vayne's. So now here this number of days or months, what number of days or months you have to take? So number of days or months post the issue, that means after the issue, how many months? That is, after 1st August is your issue date. After the issue, for how many months? was it there in the company. So it is first August, September, October, November, December. So for 5 months it was there in the company. So 5 months earnings it has to get. So in the numerator also you will write 5 months. So numerator also you are going to write 5 months. The same way here also number of days or months post buyback. That means buyback if it has happened on 1st November. So 1st November to December end would be 2 months. So for 2 months, this earnings, so for the 2 months earnings after the buyback, the shareholders will not get. So these 2 months earning you're going to write here, and that is what you're going to less from the calculation, because the shareholder should not get this. So these shareholders should not get it. So you are going to reduce it from the calculation. I hope you understood this Vane's calculation part clearly. Okay, so now that we have understood how to find out the profit and loss, that is the numerator, as well as the denominator, which is the weighted average number of shares, we will be able to find out the basic EPS. But there are a few points that you would need to understand in case of any special case that arises. So here there are given 3 special cases that we have to understand. Let's understand them one by one. Okay, starting with the partly paid up shares. That means what they're telling is the face value of the share is 10 rupees, but you have only paid a value of 5 rupees on it. That means you have only partly paid up that value. A value of share which is of 10 rupees, you have only paid how much for it? 5 rupees for it. So here in such case, what you have to do, like how you are multiplying the period weight here, you have to multiply value weight also here. You have to multiply value weight also here. So you have to do multiply the number of shares by partly paid up value, which is 5 rupees, divided by what is the issue price or the full price, which is 10 rupees, in the Vane's calculation. So like how you are doing the period weight here, multiply the value weight also here as 5 by 10. So in whichever there is a partly paid share, accordingly you have to multiply that in the calculation. Okay, this also in the sums we will learn. Just now for remember, if it's a partly paid up share, you have to take that also into consideration and do a value weight. Okay. Second special case was the bonus shares, which I already told you about how to treat it. Now here there is one more case about it. Okay, so what are bonus shares? Bonus shares are those shares which are issued to the existing shareholders without any consideration. That means you do not collect a single penny from the shareholders, but the company is going to issue it to them free of cost. Okay, so how does the company bring money for it? What it does, it capitalizes its reserve to do the bonus share issue. I hope by this everybody and by now knows how this works. Okay, so you capitalize the reserves to bring in the bonus shares. Fine. So if in the case a bonus ratio is given in the question, that means for each one second, yeah. So for each 2 shares already held in the company is going to issue 1 bonus share. If something like this, like a bonus ratio is given in the question, then in such case you have to find something called as a bonus adjustment factor. So what is this bonus adjustment factor? So bonus adjustment factor means you have to do 1 plus whatever the bonus ratio is, The bonus ratio right here is 1 by 2. For every 2 shares held in the company, you are going to issue 1 share. So 1 plus 1 by 2, how much would it be? It would be 3 by 2. It is going to be 3 by 2. So this is your bonus adjustment factor. You have to find out this ratio. So now what are you going to do with this ratio or this bonus adjustment factor is that in the current year EPS, in your Vane's calculation, while you're doing this Vane's calculation, instead of directly writing the bonus share like this, find out what are the number of bonus shares before how much number of shares are there in the company before the bonus issue, how much number of shares are there in the company before bonus issue, which is, for example, there are 100 shares in the company, there are suppose 200 shares in the company. You have to now multiply it by 3 by 2. Which will give you 300 shares, in total. Okay, so like this you have to find out and write this 300 shares here against the bonus shares. Okay, next, if in the previous year EPS also you have to restate it. What does this restatement mean? Let's now understand more about restatement. So now what does restatement mean? Okay, now remember Do you remember that in the start of this lecture, we understood something about comparison, performance comparison. So I told you, in an intra firm, that means within a single entity itself, that means I told you, now let's take company 1. In the company 1 itself, I told you that see the previous year EPS, how much it has earned. It has earned 10 rupees. How much it has earned in the current year? How much it has earned in the current year? 8 rupees. So now by comparing the previous year performance and the current year performance, or previous year EPS and the current year EPS, in the company 1 itself, you are able to understand the performance has been deteriorated. Okay. But what happens? So this is a normal case. But what happens when a bonus share is issued? So what happened when a bonus share is issued? For example, now understand, in the previous year, the company earned a profit of 10 lakh rupees and distributed it between 1 lakh shareholders. So 10 rupees was the EPS. Okay, distributed it between 1 lakh shareholders. So the EPS was 10 rupees. In the current year, what happened? Again, it earned a profit of 10 lakh rupees only, and again there were shareholders of 1 lakh only. But what happened is that the company issued something called as bonus shares in the company. That means the company did not bring in any new money. The company did not bring in any new money into the company, but instead only issued shares. The company did not get any money against it, but only instead issued shares. That means free shares it has issued. Suppose example, it is for example, let's take, it issued some 25,000 shares as bonus shares. That means for this 1 lakh rupees, the company got money while it was issuing the shares, but for this 25,000 shares which it issued in bonus, it did not collect any cash. For this it collected cash, for this it did not collect any cash in return. That means for this 1,25,000 shares, now if you do 10 lakh worth of earnings divided by 1,25,000 worth of shares, that earning is going to be 8 rupees. Now here the earning has deteriorated, but it is not genuinely because of any performance measure. It is only and only, that means solely because of issuing bonus shares. Okay, so this is why the performance of the company has deteriorated. But now when, as a shareholder, when I see from outside, I'll see that, oh, previous year it earned 10, current year it earned 8. That means the company must not have earned what it earned in the previous year. So that is why the performance has deteriorated. But sadly, that is not the case. Past year also the company earned 10 lakh only, current year also the company earned 10 lakh only. So that this kind of wrong message does not go, what the EPS or what does AS20 tell you is that current year EPS you are finding out including the bonus shares, correct? Including the bonus shares, correct? For which you got rupees 8. What you do, previous year EPS, the original previous year EPS was 10 rupees. Leave that. Now find out something known as previous year EPS, which is restated. So here what you do, imagine that the bonus shares, if it would have been issued in the previous year itself, if the bonus shares would have been issued in the previous year itself, then in such case what would have been the EPS? So previous year the earnings was 10 lakh rupees. The equity shareholders were 1 lakh. Now imagine current year there were 25,000 shares which was issued as bonus share. It also got issued in the previous year itself. So totally there were 1,25,000 shares. So 1,25,000 shares and 10 lakh was earning. If you do 10 lakh divided by 1.25 lakh shares, then in such case, in previous year also the company would have earned 8 rupees only. The company in the previous year would have also earned 8 rupees only. So here what the AS20 says is, now when a shareholder is going to come and compare the current year EPS and the previous year EPS, he will see that the earnings are the same only. There was no difference in the performance of the company. So he will be able to make a better decision. So what AS20 tells? If bonus shares are issued in the current year, then in such case, what you have to do is previous year EPS also you have to restate and show. That means in the variance calculation for the previous year, that means in the denominator, you have to do number of shares which were there in the previous year multiplied by the bonus adjustment factor, multiplied by the bonus adjustment factor for the previous year also you have to do. So current year, previous year, both year you will have an impact. Okay. So I hope you understood this. Now moving on. So this was if there is a bonus ratio given in the question. This is if bonus ratio is given in the question. If bonus shares are directly given in the question, if the number of bonus shares that are going to be issued is directly given in the question, instead of writing what is the ratio, they have given you directly that 20,000 bonus shares we are going to issue, like that directly they are given in numbers. Then what you do, then you have to add such bonus shares in the variance calculation. So in the variance calculation, you can come and directly add it. This you have to do in the current year also, and this you have to do in the previous year restatement also. But here you do not consider any time adjustment. Please don't consider any time adjustment for this. Assume that it was issued at the start of the year itself. So don't do any time adjustment, irrespective of whether it was issued in the start of the year, mid of the year, or end of the year. You will still not do any time adjustment. I hope these 2 points are clear to you, and the bonus shares is also clear to you. Now let's move on to the most important one, which is the rights issue. Okay, please understand this carefully. Now let's move on to something called as rights issue. Okay. So what is rights issue? So if you understand the third special case of rights issue, so rights issue, they are telling you that shares are issued to the existing shareholders at a price which is below the current market price of the share, So when it is a rights issue case, what here? So here what they do is that in rights issue, the company will tell you that, see, in the market, the current price of the share is 25 rupees. Okay. But I will issue, because you are my existing shareholder in the company, I am going to give you a special issue price of suppose 15 rupees. That means the existing shareholder in the company gets a right that they can purchase the shares which is sold in the market for 25 rupees at just 15 rupees itself. So here what happens, 15 rupees the shareholder will pay. But what about the remaining 10 rupees? The remaining 10 rupees the company is going to bear and going to issue it for free. And this 10 rupees is like a free element. The 10 rupees is like a free element here. In bonus issue, we used to say that the market price is 25 rupees, but I am going to issue you at zero cost. In rights issue, they are saying you need not pay the full cost, but at least pay 15 rupees. Let the rest 10 rupees be your free element or a bonus element. So here they are telling that rights issue has some bonus element in this. That means this 10 rupees which is issued for free, this is a bonus element which needs to be adjusted again. So wherever there is a bonus element, you need to adjust it. How are you going to adjust it? So you have to again do a current year calculation also and a previous year restatement also. So in the current year, how are you going to find out the variance? We are going to understand. So first this is the calculation you have to do. Okay, so this is the calculation you have to do. First you have to take number of equity shares which are outstanding before the rights issue date. How much equity shares were there? Multiplied by something called as a rights adjustment factor, then multiplied by the period weight. So number of months till the rights issue date. For example, number of equity shares outstanding before the rights issue date. Before issuing the rights issue, there were 1 lakh shares in the company. Before issuing the rights share. Okay. And suppose the right adjustment factor we found out to be 1.05. Example I have taken. I will tell you how to find this out. Multiplied the number of months till right issue. Suppose the rights issue was done in the month of August 1st. So until this month, that is January to December is your financial year. Until August 1st was your right issue date. That means January, February, March, April, May, June, July. So 7 months. So 7 months divided by 12 months. First you do this. Then you have to add. How much total number of equity shares were there after rights issue. So before rights issue, there were 1 lakh shares. How much shares were done as right issue? 20,000 shares, for example. So total Number of shares after rights issue was 1,20,000. So it was 1,20,000. Now directly multiply it this by number of months after right issue. Number of months after right issue was 5 months, which is from August to December, divided by 12 months. So you have to do this calculation to find out the rights issue adjustment in the Vane's calculation, to find out the current year Vane's calculation. So okay, so in the current year when you do the Vane's calculation, you will here include something called as rights share also, something called as rights issue shares also. Okay, so when you are going to do this, you will include this here also, and for this how you have to calculate we have understood here. Okay, I hope you understood this. In the previous year, what you have to do, you have to take the number of shares and multiply it by the risk adjustment factor, and you have to multiply it by the risk adjustment factor in the previous year weights. So now the remaining calculation is pretty simple how you have to do. So here the remaining calculation which is there, how to find out the current year Vane's, previous year Vane's, is all pretty simple. You need to only understand how to find out the risk adjustment factor. So how you have to find out risk adjustment factor? Here I have given you, there is only one step to it. You have to take what is the current market price and divide it by what is the theoretical ex-right value per share. Theoretical ex-right value per share. The current market price, as we told, was 25 rupees. Now you have to find out what is the theoretical ex-right value per share. You have to just find this out, and if you multiply this, you will get your rights adjustment factor, and that element you have to multiply. Okay, so now how do you find out theoretical ex-right price? This is a calculation you have to do for that. You have to take what is the existing MPS. I told you it was 25 rupees. Multiply what were the existing number of shares. I told you that there were 1 lakh shares in the company. Okay, and add it by what was the rights issue price. I told the rights issue price is 15 rupees. How many shares are you going to do as rights issue? I told you it was 20,000 shares. Multiply that and then divide it by number of existing shares. We had 1 lakh shares in the company. Add it by number of rights share, which is 20,000 shares. So if you do this calculation, you will be able to arrive at the theoretical ex-right value per share, which you have to divide it here, and you will be able to find out your rights adjustment factor. And then you have to use this rights adjustment factor here as well as here. I hope you understood this rights issue part also. If there is any confusion, please make sure you're watching the part 2 video where I'll be doing a question on this, so you're able to clearly understand. Okay, I hope this rights issue is done. So with this, our basic EPS is done. So what did we learn in basic EPS? How to find out the basic EPS, how to find out the profit and loss, how to find out the weighted average. And then we saw some special cases where we saw what is partly paid up, what is bonus shares, and what is rights issue. So this was all about your basic EPS. Okay. Now we are going to move further on and go to our next part where we are going to understand what is the diluted EPS. So in the starting we read, right, one was basic EPS, we have finished that. Now we are going to understand what is diluted EPS. Let's move on to diluted EPS. So do you remember that we read something called as potential equity shares in the start? So what they are telling you in diluted EPS is that, see, currently in the company, see here they are saying that, see, today our company is earning 10 lakh rupees and there is only 1 lakh shareholders in the company. There is only, you are earning 10 lakh rupees and it is getting distributed among 1 lakh shareholders. What will happen in the company 10 years after? What will happen in the company 10 years after is that, if you keep earning the same 10 lakh rupees, and suppose what happens is that the debentures that we have today gets converted into some equity shares, tomorrow. Suppose there were 100 debentures, or suppose there were 2 lakh debentures, not 100, 2 lakh debentures, which got converted into 10,000 equity shares, in the future, because these were convertible debentures. This 2 lakh convertible debentures got converted into 10,000 equity shares in the future. Okay, so what will happen is that while you are seeing the denominator part, you will have 1 lakh shareholders who are already there in the company, plus there will be 10,000 more shareholders in the company because of this convertible part, which we call as potential equity shares. Now here what will happen is that when this convertible debenture get converted into an equity share, our equity shares will get increased. That is one thing. There will be a second effect to it. where what will happen is all through this years, all through this 10 years until the debentures were there in the company, you paid interest to the debentures. You paid something called as interest to the debentures. From now on, once it has been converted to the equity shares part, you need not pay any interest. You need not pay any interest. So you will have some savings in interest. So you will have something called as savings and interest. So this will also increase your earnings. So your earnings will get increased because you're saving some interest. You're saving some interest and you're not paying it out. Okay. So that will get added to the numerator. In the denominator, because the shares have increased, the shares will get added. So because of this, what will be the effect on EPS? Because of this, what will be the effect on EPS is what we are going to understand in the diluted EPS part. Because of those potential equity shares, if these potential equity shares turn into real equity shares in the future, what will be the effect on, what will be its effect on EPS, or what will be its effect on basic EPS is what we call as diluted EPS, is what we call as diluted EPS. Okay, I hope you understood this. So here what they are saying is that we call an EPS to be a diluted EPS only and only when there is a reduction in basic EPS. That means today we were earning 10 rupees as EPS. In the future, after 10 years, we will be earning suppose only 8 rupees as EPS solely because of this potential equity shares. Because of this potential equity shares, then such reduction in EPS is called as dilution. It is called as dilution because the EPS has weakened. The EPS has weakened because of this potential equity shares, because the EPS has gone down, has reduced, has been diluted because of this potential equity shares. So that's why this reduction in EPS due to the potential equity shares are called as diluted EPS. Now if you ask me, if there was a 10 rupee EPS and in the future after 10 years, if this 10 rupees became 11 rupees, will this also be called as a diluted EPS? The answer is no. This will not be called as a diluted EPS. Okay, only when there is a reduction in basic EPS due to the assumption of potential equity shares are being issued, only then it will be called as a diluted EPS. I hope you understood this. So now how are you going to calculate the diluted EPS? Whatever the basic EPS formula was same, after that you have to do some addition. So what was the profit and loss which you used in basic EPS divided by the gains that you used in basic EPS? You have to add to it in the denominator the shares due to potential equity shares. Like I told you, right, here 10,000 shares have been issued as a conversion of those debentures. So 10,000 those shares you have to add here, and in the above you have to add something called as earnings due to potential equity shares. Earnings means here I told you, you had some savings and interest because you will have to no more pay interest. So that savings and interest you will add here. Okay, so the formula is PN, profit and loss, which you use in basic EPS, plus if there is any adjustment in earning, divided by the gains that you use in basic EPS, plus the extra shares that have been issued due to potential equity shares. Take that. If you do this, you will be able to find out your diluted EPS. If you do this, you will be able to find out your diluted EPS. Okay. Now here, if the diluted EPS is less than basic EPS, suppose your basic EPS I told you was 10 rupees. If diluted EPS is 8 rupees, that means it's a reduction in EPS, then it is called as diluted and you will report it and you will be reporting it. But if the basic EPS was 10 rupees, diluted EPS become 11 rupees. That means it has not reduced, it is more than the basic EPS, then it is anti-diluted. So you need not report it, You can directly consider that DEPS will be equal to BEPS. When you are reporting, you can directly show BEPS also 10, DEPS also 11. Okay, I hope you understood this part also. So now adjustment, how you are going to do to the potential equity share. That means the numerator and the denominator. How are you going to do the adjustments? What is your numerator part? What was your numerator part? Your numerator part is your earnings, that is your P&L. Your denominator part is your gains. So what is the adjustment you are going to do? That adjustment I have noted it down here, so directly you can make it. When it's a convertible preference shares. So when it is a convertible preference share and when a preference share gets converted into an equity share, there will be two things. One, preference dividend need not be paid anymore. Preference dividend need not be paid anymore. Number 2, there will be an increase in the equity shares, in the number of equity shares. If the conversion happens, you need not pay preference dividend anymore, plus the equity shares will also get increased. So in the numerator, you will add preference dividend because earlier the earning was only 10 lakh rupees to the equity shareholder, because you used to pay preference dividend. Now this preference dividend will not be paid to the preference shareholder. So the 2 lakh rupees of preference dividend will also belong to the equity shareholders only. So today, after the potential equity shares are being converted, totally 12 lakh rupees will be given to equity shareholders. This preference dividend will also come to the equity shareholders because there are no more preference shares. Okay, so your earnings will increase. So you will do plus preference dividend here. In the denominator, you will add the number of equity shares which you get on conversion. From the preference share to the equity shares, how many shares have been converted, write that number of equity shares here. Okay, you have to consider something called as time factor also. So you have to multiply this with the denominator which is there, you have to multiply that denominator with the variance. You have to multiply it with the time factor also here. Factor is that starting from year beginning or the issue date till the year end or the conversion date, you have to take that time factor. So if this potential equity share was there from the year beginning to the year end, it will be 12 by 12. But no, during the year itself, if during the year only it has got issued, or during the year only it has got converted, then accordingly you have to take those dates. So which date to which date you will take, from the year beginning or the issue date, whichever is later, divided by the year end or the conversion date, whichever is earlier. Take that number of months and you have to multiply it. I hope you understood. This. Next is convertible debentures. Debentures, I told you, in the numerator you will add your savings in interest. Your savings in interest is going to be interest into 1 minus tax. In the denominator, you will add the equity shares which have come on conversion. The time factor here is going to be same as your preference shares, from year beginning to issue date, whichever is later, to year end or conversion date, whichever is earlier. So the same time factor also you can take. Now how you have to do this time factor, if you are a little confused, again in the part 2 I am going to teach you there practically, so watch that part to understand this better. Next, there is something called as options or warrants. For this numerator, there will be no impact. There will be in the denominator. How you will find out the number of shares is number of equity shares which are there under options multiplied by the market price minus exercise price divided by market price. If you do so, you will find out what is the adjustment in the denominator, and for this the time factor you have to take as from year beginning or grant date, whichever is later, to year end or exercise date, whichever is earlier. Okay, and the final one is your contingent shares. For contingent shares also, numerator there will be no impact. Denominator, take the equity shares which were promised, and then for time factor you again take from the year beginning or agreement date, whichever is later, to year end or share issue date, whichever was earlier. Okay, so you have to take this time factor as well. These dates everything will be directly given in the question, so you need not worry about it too much. It will be directly stated in the question itself. Okay, so I hope you understood how you have to calculate the diluted EPS as well, and how you have to do the adjustments. I've clearly stated. So for each shares, debentures, warrants, as well as contingent shares, I've clearly stated what will be the impact. Okay, do this impact and find out your diluted EPS. Okay, so here say they have given you a summary which was given in your ICAI textbook. I have just taken it here. If due to those conversion, if there is a decrease in earnings, then it is diluted. If there is an increase in earnings, that means if it became from 10 to 8, it is diluted. If the EPS became from 10 to 11, it is anti-diluted. Okay, if there is an increase in loss, earlier the loss was 10 rupees. Now the loss is 11 rupees. That means loss is increased. So it is diluted. Earlier the loss was 10 rupees. Now but the loss is only 8 rupees. It means it is anti-diluted. So the summary also I have given you here, which you can take. Okay, there is a negative impact. That means either the profit has decreased or the loss has increased. Only then you will show it as a diluted EPS. Okay, I hope you understood this. So this was all about your AS20 and all the concepts I have covered here. I hope you understood this lecture thoroughly. If you did, please make sure to like, share, and also subscribe to this channel. And also make sure to leave a comment down below on how much you understood this, and if there are any doubts, post that as well. And see you in the part 2 where we'll be discussing all the questions. And yes, thank you so much.